Welcome to the annual Private Equity and Venture Capital Compensation Report Summary. I'm David Kohanek, publisher of the report, and in our many years of publishing the annual Private Equity and VC Comp Report, both before and after the peak, we've seen significant changes in how private equity and VC Comp works. We feel a responsibility to present a comprehensive benchmark that's reliable and affordable. The Private Equity Comp Report has grown to become the most comprehensive benchmark for the industry, and we're pleased to bring you this summary today. Annually, the Private Equity Compensation Team conducts a comprehensive survey to reveal insights into the changing landscape of private equity compensation. The data is collected in Q4 of each year to get the best picture of how the year will wrap up. All of the data is collected directly from private equity and venture capital professionals. With more than 40 detailed charts and graphs, we've prepared this report to help you understand the industry pay benchmarks and changes in compensation practices. The report addresses core compensation topics, much more than just cash compensation, and some of the big questions answered include compensation median, averages, and ranges, base versus bonus payouts, which titles are earning the most and how are they earning? Who shares in the carried interest and at what level? How does fund size and performance affect pay? The impact of hours worked on compensation, vacation earned versus vacation taken, and much more than that. As you can see, it does address the big picture of compensation packages provided within the private equity industry. Now, before we get into this year's results, I just wanted to take a moment and talk about the big picture of the industry. The first is, it is a cautious environment right now. Investors are being cautious, but that doesn't change the fact that they are sitting on over $400 billion in dry powder, and they're going to need to invest this capital at some point. And deal flow has been slowing, so it makes for an interesting dynamic. After 2 straight years of increasing investment activity, we actually saw deal flow starting to slow in 2012. And many of these deals are actually smaller in size, that is less than $50 million in value. Private equity portfolios are growing larger, and they're also getting older. The companies that make up these portfolios have been invested in many years ago. Exit activity has been fairly steady for the last couple of years, at least in terms of deal count, but we do expect that activity to increase over the next couple of years. With all of this dry powder available and the smaller deal sizes, we expect it to take some time to put that capital to work. So fundraising really isn't going to be an issue, at least for the larger fund. And of course, for the smaller funds, we expect fundraising to continue at a brisk pace. The majority of our respondents this year represent the mid-career stage, which is typically what we see. 76% report between 6 and 15 years of work experience. The midpoint in terms of experience remains at approximately 10 years, which is what we typically see as well. Depending on whether the firm is a venture capital or a pure play private equity team, it seems that compensation can vary substantially between respondents with similar titles. This reflects differences in responsibilities between firms, and it also highlights the risk of focusing excessively on title when comparing compensation levels. People at smaller firms may have the same title as someone at a larger firm, but they wear many more hats. Respondents indicated substantially higher compensation if they worked at a firm where the most recent fund size was over $1 billion. And the gap between medium-sized funds and large funds in terms of compensation increased considerably this year, from 34% in 2011 to 76% in 2012. In terms of firm size, there's also been a slight increase year over year. Respondents employed by firms with more than 100 team members now number over 22%, whereas last year's survey, we only saw that number at 16%. On the lower end, the reverse is true, with the number of respondents reporting a firm size of less than 5 declining from 22% down to just 18% this year. Those in private equity and venture capital firms have tended to fare better than their investment banking brethren over the past few years. and their optimism has clearly improved in this year's results when compared to last year. In 2012, 62% of people are expecting some level of an increase in compensation, up from 46% last year. In addition, the number of respondents expecting a double-digit increase climbed by 3%. On average, this year's projected bonuses are reported at 36% of total compensation, which is down from last year. In terms of 2012 compensation, those earning over $500,000 saw more earnings coming from their bonuses than their base salaries. And the inverse was true, of course, for those earning less than $500,000. Expectations of fund performance for 2012 were considerably improved versus the 2011 responses. This translates into significant increases in bonuses over last year. Nearly 80% of respondents expected a positive year for their fund, and those anticipating negative returns for the year also declined, from 9% last year to just 6% this year. The expected bonus level data shows a considerable change from last year. Expected bonuses for firms with down or even returns for the year have considerably dropped off when comparing it to 2011 data, while those employed by funds with strong returns have higher expectations of bonuses this year. Last year, our data indicated a nearly flat profile to bonuses, regardless of expected fund performance. This year, however, performance is certainly critical to achieving top levels of incentive pay. The full report goes into compensation levels, both base and bonus, by firm size, employees, and assets under management, as well as the size of the most recent fund. And here are just a couple of the summary graphs that are available in the full report. In private equity and venture capital, carried interest allocations are typically around 20% of the fund's profit. In select cases, it can be substantially higher. Total carried interest is distributed to the fund team members based on their personal carry or their share of the fee. When comparing this to last year, the number of firms with a carried interest pool greater than 20% increased slightly. Respondents reported a carry pool below the standard 20% were unchanged year over year. Perhaps the greatest indicator of whether one receives carry is the length of work experience that they have, as the more work experience someone has usually translates into a higher level position within the firm. The general trend holds true, and we see an increase in the percentage of participation in carried interest in the 10 to 19 years of experience range. Inexperienced workers with 2 to 5 years of experience actually saw their carried interest participation drop off this year. In the full report, we break out 3 separate graphs that show the detail surrounding how carry is allocated. The data is grouped by level based on titles within the firm. The Private Equity Comp Report has grown to become the most comprehensive benchmark for private equity and venture capital compensation in the industry. Unfortunately, we don't have time on this video to go through the entire private equity compensation report. As you can see, there are 46 detailed charts and graphs designed specifically to help you understand the industry pay benchmarks and the guidelines in the private equity and VC comp practices. If you're interested in learning more about private equity comp, you can purchase and download instantly the full report at privateequitycompensation.com. Thank you and good luck with your efforts, whether you're negotiating your own comp package or you're setting benchmark for your firm's compensation policies.